With the rising cost of home prices, rent, taxes, insurance, groceries, you name it, people are going in together financially to purchase a home, to buy together, to live together. Now, while that looks great on paper, it's turning into an absolute train wreck, and here's why. You see, a $500,000 home, and yes, that's the average price of a home right now in the United States, will cost you $3,200 a month. And that's just the principal and interest payment. Add to that the taxes, the insurance, and the private mortgage insurance, and you're around $4,500 a month. And that's after you put a 10%, yes, a $50,000 down payment. Now, I don't know about you, but many people don't have $50,000 to put down on a home. And even if they did, they wouldn't want to deplete all their cash and put it into a single family dwelling, even if it is their home. As a result, people are finding it appealing to combine their cash and their income to purchase a home. However, it takes more than just the cash for the down payment. You see, there's closing costs, and if the seller won't pay your closing cost, that will run you 3.5%. And on a $500,000 home, that's going to cost an additional $17,500 over and above the $50,000. Now, one also has to look at the average income in the United States. The average household income is $80,000. The average household also has $33,000 in credit card debt. If you have an income of $80,000 with the interest rate at 7%, that only qualifies you for a $250,000 home. But what does that mean in terms of qualification? You need $13,000 a month, and that's with no payments, no debt payments, no car notes, no credit cards, no nothing. If you make $13,000 gross income, $156,000 a year, with no debt whatsoever, you can qualify for a $500,000 home. So you can see why it looks really good on paper to combine incomes to be able to purchase the average price of a home in the United States. However, the outcome, it's not too good. So what's happening is that it's fun and exciting in the beginning. You purchased a home, you got a new home, you got a roommate, you're saving money, you're splitting monies, you're putting money away, then you realize, wait a minute, who's cutting the grass? Who's doing the pressure washing? Who's cleaning out the gutters? Why is she leaving her clothes everywhere? There's wet towels on the floor. What the hell? And then you start to realize you do need a little place of your own. You do need a little place to call home. As a result of buying houses together, you get a little snippy with each other. Now, I've never personally purchased a house with friends or family and moved in together. Perhaps you have. If so, leave a comment whether it's good or bad. Oftentimes, it doesn't end well. You end up losing your friends, losing your family, not talking to each other. As a result, you're oftentimes better off renting until you can save up for the down payment, get your credit right, or be established on your job so you can purchase your own home. Now, I know that may seem hard for some people because you're ready to get into a home, you're ready to purchase a place, but the biggest reason that people cannot purchase houses is not their credit score. Most people have a credit score of 620 or higher. It's not their income. Most people have the income, they have a career, they have money coming in. It's the down payment. The down payment is the challenge. That's the problem. But the issue arises when people have the perception, they think they need 20% down to purchase a house. You do not have to have 20% down. You can get an FHA loan and you only need 3.5% down, 3.5% of the purchase price for your down payment. The seller can pay all of your closing costs. Now, on a $275,000 house, that's less than $10,000 down out of pocket, and your payment's going to run you around $2,300 a month. But it can be better. So here's how it gets better. USDA is a loan program that's available in all 50 states. You can purchase a house and you only need $1,000 out of pocket. However, there's a catch. You can't purchase a home in major metropolitan cities. You have to be on the outskirts, 30 to 40 miles, if you will, outside of major city limits in the suburban areas. But if you're okay with that, moving outside of city limits, listen, there are hundreds of people on a daily basis that we help around the country purchase properties this way. You need a 620 or higher credit score. You need to be on your job 2 years and show proof that you can actually pay and cover that mortgage payment. Of course, they're going to look at your debt to income ratios and all that information. But this isn't a legit program that you can purchase a house, the seller can pay your closing costs, and you only need $1,000 out of pocket. Now, if you haven't already done so, you may want to subscribe to the channel. My name is Wayne Turner. For nearly 30 years, I've done just about everything when it comes to real estate. More importantly, I've helped thousands of people purchase their homes. And I share that with you so you can have the confidence knowing that what you learn from me is from actual real life experience. Now, what if you're thinking, Wayne, I don't have a problem with the cash. I have cash, but my credit's bruised because I went through a separation, or I just started a new job, or I'm self-employed to write a lot of stuff off. Then you should consider doing an owner-financed house. There are homes all around the country. You just have to do a little digging, do a little searching, get with a good real estate agent, tell them, hey, I have 10% to put down, because typically that's what you're going to need. If it's a $200,000 house, you're going to need 20 grand. You're going to need that 10% to put down. Are there closing costs? No, there's no loan involved. It's just you and a homeowner. And that's a means of which, if you have bruised credit, typically they don't pull a credit report, but they may ask you, hey, what's the deal? What's the situation? What happened at your credit score? What happened at your income? Because they're really not looking for proof of income or credit, if you will, but they certainly want to make sure that if you put a large down payment on the house, you're going to continue to pay the payment. Now, worst case scenario, if you stop paying the payment, they can evict you from the home and you lose your deposit and the home. But that's not the only way that you can purchase a house for no money out of pocket. If you are someone that you know has served the armed forces and they've had an honorable discharge, all they need is their DD-214 to show proof of that. Of course, you got to have a 620 or higher credit score. You got to show proof of income, but you can purchase a house for no money out of pocket. The Veterans Administration guarantees the loans, and when they guarantee the loan, that means you don't need any cash out of pocket. However, you will need the seller to pay your closing costs. VA administration, no PMI, and literally it doesn't cost you any money to put down. So let's talk about another option. Let's say you get your credit score up to 620 or score 620, you've been on a job a couple of years and you have a little bit of cash reserves. Or maybe you don't have cash reserves, but you do have good credit and you do have good stable job history. Well, a lot of people ask, well, Wayne, can I get a gift? Yes, you can actually get a gift. If you have someone write you a note and basically say that they will give you a down payment or a portion of the down payment, you can show proof that that is a gift and you're not going to be paying that back. You can actually use that as part of your down payment. Now, what I'm talking about, of course, FHA, but conventional is one of the better ways, and here's why. When you go conventional, the seller can pay all of your closing costs, which runs around 3.5%. When they pay all of your closing costs, you only need 5% to put down. Now you put a 5% down payment. Now don't get me wrong, $200,000 house is going to run you 10 grand, $300,000 house is going to run you $15,000, and so on, right? But here's what happens. Once you have equity in the property, once you've paid that balance down and the home's gone up in value, you can have the property appraised and the mortgage company will remove the private mortgage insurance that you're paying on a monthly basis. So look, the last thing you want to do is to cause a conflict and a divide between the people that you love your most, your family, your friends, the people that you have good relationships with. And oftentimes purchasing a house together does just that. So it's something to reconsider. There are means of which you can purchase a property individually with not a whole lot of money out of pocket that I just shared with you. There's also opportunities if you're a veteran to purchase a home for no money out of pocket. My name is Wayne Turner. Be sure and subscribe to the channel. Give me a thumbs up if you like this video. I promise you, you will learn something new on every episode.